Hello and welcome. My name is Shankar Subramani, and I'm going to give you a short presentation on break-even analysis. And I'm going to use this example of, let's say, a bicycle company, and I'm going to use the contribution income statement. So to understand what is a contribution income statement, or also known as a marginal income statement presentation, it's a little bit different from profit and loss account or the income statement that you would have probably got used to, which is sales minus cost of goods sold equals gross profit, minus all the expenses is equal to net income. You will notice here that there is the sales figure, and right after the sales figure there is the variable expenses. The variable expenses typically mean all those costs that vary with volume. So for instance, if you're selling one cycle, it costs a certain amount of material, it costs a certain amount of labor, and probably other expenses. And in management accounting, it is called as variable expenses. Now, variable overheads. So for instance, if you are consuming, let's say, some kind of supplies or some sort of indirect labor, but that varies with the number of bicycles that you manufacture, it would all be categorized as a variable expense. So sales minus variable expenses gives what's known as the contribution margin. It's called the contribution margin because it contributes towards covering fixed expenses, and we will see what fixed expenses mean, and then also contributes towards giving us some kind of a net income. So fixed expenses are typically all those expenses which take place regardless of whether you manufacture one unit and sell one unit or not. So for instance, in this case, even if you don't sell any bicycles, or if you sell maybe 1,000 bicycles, then you will still have some fixed expenses which stay the same. So I'll give you some examples here. For instance, the rent that you pay to manufacture to have the premises to manufacture the bicycles. That kind of a rent stays fixed, assuming that you are within a certain volume of activity. Now, if you're going to manufacture, let's say, 10,000 bicycles, as against a normal 1,000 bicycles per month, of course, you need a much bigger facility. So fixed expenses are all those type of expenses which you have to incur. Now, the contribution margin minus the fixed expenses gives you the net operating income. And usually this net operating income can be reconciled with the net operating income calculated as per the conventional income statement that I just mentioned a short while ago. So this is just an introduction of some of the ideas that you need to understand the concept of break-even. The presentation is very important in any break-even type of analysis. Your presentation is always sales minus variable cost equals fixed costs. Sales minus variable cost equals contribution margin minus the fixed expenses is equal to the net income. So that has to be very clearly understood. So I would suggest even to have this noted in some kind of a short notation, if you like. So if I may use the screen to write here, it'll be S for sales. Just a second here. Yeah, sales minus variable cost will be equal to contribution margin. Will be equal to contribution margin, and contribution margin minus the fixed cost is equal to the net income or net operating income. So this format stays fixed regardless of whatever calculations or farm problems you approach. So that's something very important to bear in mind when you actually do any of the problems related to break even. So let's go to the next slide and see what we have there in terms of further analysis. So we saw sales minus variable expenses and contribution margin, all these concepts we've seen. Now, let's say if every additional bicycle that this company sells, they will make an additional contribution margin of $200 per bicycle. And this will help cover the fixed costs and also contribute towards the profit. So now something to keep in mind here is the idea of per unit calculations. So if you notice here, the total amount has been divided by the number of bicycles to get the per unit figure. So that's something to keep note of, because we will need this per unit analysis as we look into further break-even calculations. Okay, so we just clear all the drawings here. Okay, so let's go to the next slide and see make further progress with analysis. So what is the concept of break-even? Now, the concept of break-even is when that level of sales, so you want to know the level of sales. Now, that is not just the volume, but also in units, where you will have zero profit or zero loss, depends on how you want to look at it. But you want to know the level of sales that gives you zero profit or loss. Now, it's a very important concept, and almost all the businesses would have some sort of break-even analysis. If you're selling iPhones, if you're selling any equipment, cars, you want to know at what volume. Now, in this case, bicycles is a product, but you want to know at what volume would you be able to break even. So how many units of your product you need to sell where you're recovering all the costs. Now, not only you want to know how many units, but you also want to know what is the dollar value of your sales. Now, why is this important to know? You are going to plan your sales, plan your marketing campaigns, plan your advertisement expenses, and all the rest of it based on these decisions. So very important, and also maybe even allocate budgets to your marketing team. So all of that is very important in terms of running a business. So in this case, we are moving to calculate what level of sales this business requires, how many bicycles they need to sell to cover all their costs, albeit they may not make any profit, but it would cover all their costs. So let's have a look at that calculation. So I hope you understand the per unit numbers, which is basically the total numbers divided by 500. And that gives you a per unit contribution margin of $200. So going into the next slide here, if this company sells 400 units per month, okay, so this is not a formula approach. We are actually using just a trial and error method. So let's assume that we accidentally stumbled upon this 400 units, and we found that you can sell, if you're selling at a $500 price per unit, you're actually making no profit or losses. You're covering all your costs. Okay, so as you can see here, the variable expenses total to 120,000, and the contribution margin works out to be 80,000, which also happens to cover our fixed expenses. Fantastic. So this is a way of calculating break even, but that is not the normal way to do, in the sense it's a long process. I mean, I have to, what if I tried 450 and I got some profit figure here, and then I keep reducing the number. So that will mean that it's a laborious process. So there is a certain formula that can be applied, and that is what we will see in the slides that follow. But before that, if I sell one extra bike, which is 401 bikes, then my operating income starts growing from that point. So if I sell 2 bikes more, then my break even, my operating income grows by my contribution margin. So that is also another little detail that that you might want to keep track of. So the other thing to note is, from a per unit perspective, we can also move into what's called as a contribution margin ratio perspective, which is nothing else but converting everything into percent. So let's say sales per unit or in total is 100%. Variable expenses in this scenario works out to be 60% of sales. That leaves us with a contribution margin of 40%. And this can be calculated by looking at the total figures as well, which is $100,000 divided by $250,000 in sales, gives you a 40% CM ratio, which is the contribution margin ratio. In other words, for every $1 sales, you would be actually making 40 cents of profit. So this will take me to the formula for calculating break even. So if I go back to the previous slide here, where we calculated the break even as 400 units, the same principle can be arrived by taking the fixed costs and dividing that by the contribution margin per unit. So let's say in this case, the fixed cost works out to be $80,000, and the contribution margin per unit works out to be $200 per unit. And that gives us so this is $200 per unit. That gives us the break-even sales as 400 bikes. So no matter whatever the scenario, whatever may be the scenario, if you know the fixed costs and if you know the contribution margin per unit, because you have to know the variable cost also for that purpose, then you can calculate the break-even point in units by dividing fixed costs by contribution margin unit. Then if you want to arrive at the sales volume, the sales value, then you just need to multiply that by the selling price. So 400 units times $500 per unit gives us a sales value of $200,000. So if someone asks you how much you need to sell, you would say 400 units. And what is the sales volume that you would get out of this is $200,000. The other way to calculate the sales value is if you have the fixed cost, and I showed you the contribution margin ratio in the slide that we saw. And if you know the contribution margin ratio is 40%, then that gives you the sales value as well. So if I take $80,000 here, which is our fixed expense, and divide that by 40%, which is our contribution margin ratio, this will fetch us the sales value of $200,000. Now, this is, of course, we calculated here, so we can find it this way. But let's say we don't have any of this information available. We just have the fixed cost available, and we have the contribution margin ratio available. We can arrive at the sales value. So these are two basic formulas that you need to absolutely remember in this concept. Moving on. So we saw this case where 1 unit extra over the break even, you start making enough money, which is equal to the contribution margin per unit. Moving on further, we also saw the contribution margin ratio. Now, this is the formula to calculate what is called as target profit. So now you're not just interested in break even. I mean, what kind of a business would it be which is just interested in breaking even? You want to actually make some profit. So in this case, you just have one extra addition to this formula. You take the fixed expenses, which you already know, and you know the contribution margin per unit. And we saw from the previous slide that that is $200 per unit. And fixed expenses we know as $80,000. So if you have a profit figure in mind, just add the profit to the fixed expenses and you arrive the sales in units to arrive, to reach that target profit state. So if you see notice in the next slide, suppose this company wants to earn a profit of $100,000. So what should they do? So they take 100,000 here, 80,000 there, and 200 per unit, and then arrive at the unit sales to reach that target profit, which is what we will see here now. So they have to sell 900 units if they want to make a profit of 100,000 and not just break even. So we saw that 400 units was break even, but if they need the profit, they need to sell 900 units. This also helps you to plan your marketing campaign and setting sales budgets for your sales personnel. Okay. Using this CM ratio also, you can find out the sales value. This is the volume, as we say, sales value, by applying the CM ratio, which we will see in the following slide. So you have the target profit, which is 100,000, not changed. Fixed expenses we know, and we know the CM ratio. Applying that, we can find out that the dollar sales required to reach the $100,000 profit is $450,000. And this can be calculated also from the figure which we saw in the previous slide, which is $900 times $500 per unit, which is the selling price. So 900 units, I beg your pardon, 900 units times $500 is equal to $450,000 worth of sales that you need to achieve to realize $100,000 profit. Okay, we have seen the dollar sales to break even. This formula I've explained already, and this is something which you can just recap at this point. And some of the assumptions related to break even is very important to keep track of. This is the assumption that the selling price always remains constant. Now, when you sell items, usually the selling price could change over a period of time. But if the selling price changes, remember our contribution margin per unit changes and the contribution margin ratio also changes. So if you want to keep the break-even calculations or come at a break-even figure and also plan your profit figures, your assumption is that selling price remains constant. The other assumption is that costs are linear and can be accurately divided into variable costs and fixed costs. Linear means, let's say I sell 2 units and each unit costs me variable cost of $300. My variable cost in total is $600. But let's say I sell 50 units, I'm also assuming that my variable cost per unit is not going to change. My total cost, of course, will be $15,000, but my unit cost will not change. And then let's say if I'm selling 100,000 units, my variable cost per unit also will not change. So remember, break-even is not going to be valid beyond a certain range of volume. So it's called the relevant range in theory. So this is your relevant range, and per unit variable cost remains the same. Likewise, the fixed cost. So if I sell 1 unit or 10,000 units in the example that we saw, the fixed cost will remain as 80,000. And that's an assumption that you're making. And sometimes these assumptions can be questioned, so you would want to revise your break-even calculations once these assignments change. Okay. In multi-product companies, so in this example we just saw that we're selling bicycle, but then usually companies just don't sell one product, they have multi-products. Now in this case, there's a concept of sales mix. So what percent of product 1, what percent of product 2, what percent of product 3 constitutes your total sales? That comes into play. And when we go in further into this topic, we will see how to calculate that. Finally, there is no inventories at the beginning or at the end, because if you have inventories, the cost of those inventories would affect your calculations. So these are some of the assumptions that you make when you calculate the break-even point. So some of the things that we saw today is how to calculate the break-even point, how to calculate that point where you want to make an X amount of profit, why it is important to calculate break-even point, what is the formula that we use to calculate break-even point, and also some of the assumptions relating to break-even point. I hope this gives you some understanding of the concepts related to break-even point. Thank you.